Good day, students. I will be doing the question paper for the year 2013. And it says Rodi's workshop had the following pre-adjustment trial balance on the 31st of December 2012. So we are given a trial balance for this business, and to highlight few things, we are given the asset being a machine, the accumulated depreciation for that machine. Then after, we are also given fixed deposit, bank account, debtors. Our stationery on hand is 800 rand, and remember, whenever we are given a stationery at the beginning of the year, we have to make a reversal of that, where it has to be reversed and be transferred into the stationery expense account. So now we'll have to make a reversal for that. Take note, we also have accrued interest income, and this was accrued by the beginning of January, and a reversal will also have to be taken into account with regard to this. These are very important things to note whenever you are given a trial balance. Then after, we are also given accrued expense, which is accrued telephone expense. Once again, accrued expense that must have been on the beginning of the period, and that is accrued expense of 2,350 rand. So now same applies, will do the same thing where a reversal has to take place for that accrued expense. Then we are given a loan that was taken from Basa Bank, and the loan amounted to 150,000 rands, and we have the capital of 102,900, and there are drawings that were made during the year, and the service income in terms of repairs amounted to 319,180, and we have interest income that was received, which is interest received was 2,500. Remember, this is the amount that was already received, and stationery expense that was purchased during the year amounted to 4,500. This was the stationery that was purchased during the year. Then we have rent, and the rent expense is 156,000 rands, and this is the rent that was already paid during the year, and this is the stationery that was purchased during the year. Then after, we have insurance of 8,600. This insurance was paid during the year, and the telephone is also the telephone that was paid during the year, and also water and electricity is the water and electricity that was paid during the year. Then after, we have interest expense, which is normally called finance cost, and that is 10,500 interest that was already paid during the current accounting period. Then we are given the notes to take into account, and it says the following notes or adjustments and additional information still have to be taken into account. So now this is the information that must still be accounted for and has not yet been provided or accounted for in the trial balance. And it says provide for depreciation on a machinery for the year, and that is 16,000 rands. So the depreciation for the machinery was 16,000 rands, and they tell us that the machinery was purchased 2 years ago, and it will be used by Rhodis for the 5 years and will have a residual value of 25,000 rands at the end of 5 years. That means the value of this machine, or this machine, can be sold at the value of 25,000 rands at the end of 5 years. And Rhodis uses the straight line method of calculating depreciation. So now in this case, remember, we are already given 16,000 as depreciation for the year. So there is nothing to worry in terms of calculations. They just gave us the policy with regard to the calculation of depreciation on equipment, that it is for 5 years and the straight line method. We are also told under number B that the fixed deposit bears interest at 5% per annum, and there was a fixed deposit that appeared in the trial balance, and the fixed deposit appeared in the trial balance at an amount of 152,000 rands, and they say it bears interest at 5%. So now if it bears interest at 5%, it means that 5% of that 152,000 rands supposed to be interest income. So now meaning that if we say 152,000 rands, we multiply that by 5 and we divide that by 100, it should give us the interest that was supposed to be received for the current year. So now interest that was supposed to be received is 7,600. However, in the trial balance, we see that there was already interest that was received, and the interest that was received only amounted to 2,500. So now obviously there will definitely be an accrued income, because we receive less than what we're supposed to have received, because we're supposed to receive 7,600, but we only received 2,500 rands. Then we continue on that same note. Then it says under number C that stationery on hand is 7,750 rands. So now whenever we are faced with this entry, we just debit our stationery expense. Normally whenever we are required to do a general entry, it will be stationery expense, and that stationery expense will be 750, and we have to credit our stationery on hand, which is an asset, and stationery on hand will be credited by 750 rands. Then on the same note, it says under number D that the accountant has recorded telephone expense accrued of 2,350. So the telephone accrued was supposed to be 2,350 at the 31st of December 2012 by making the following entries. So now he debited telephone by 2,350 and credited accrued telephone by 2,350. Then now we are told below that however, it says however, it was noted that the accrued telephone expense at year end is actually 2,530. So now it means it was underestimated. Instead of recording 2,530, they recorded 2,350. 2,530 less 2,350. It means there is a difference of 180 rand that was not recorded with regard to the accrued telephone expense by the end of the current year. So now we still have to account for that 180 when we do adjustments, and also affect that in our statement of financial position. Then now we have to do number E. Number E says that the loan from Basa Bank is repayable in equal installments of 50,000 rands per annum. So now it means the annual installment is 50,000 rands, and it is payable on the 1st of January of each and every year. Now remember, we are doing the books for the year end 31st December each and every year. The accounting period for this business 31st December each and every year, of which in this case is 2012. Meaning now if we are doing the books for the end of December 2012, it means the next payment will take place one day after the end of the accounting period, which is the 1st of January. So now meaning the 50,000 of the loan will be recognized as a portion of the current loan, or a portion of the loan, or a current portion of the loan. Therefore now this will be recorded under current liabilities. Then we are told under number F that rent is paid 1 month in advance. Meaning 1 month in advance, it means it's prepaid. Meaning it's prepaid 1 month in advance. And the rent expense therefore include the rent for January. In other words, they are telling us that the rent that appears in the trial balance, which is the rent that was already paid, the rent of 156,000 rands already paid, is the rent that is for 13 months. So now, meaning if you want to know the rent per month, we'll say 156,000 rands, and we divide that by 13, and it will give us 12,000 rands as the rent for 1 month. Therefore, now it means the prepaid rent expense will be 12,000 rands, the rent that is paid 1 month before, which is paid for the month of January. Then after we are under number G, and number G says, after carefully review, it was found that the insurance expense for December 2012 500 was not yet accounted for. So now it means 500 of the expense was accrued. They say it was not yet accounted for. That means not yet paid. Therefore now, meaning the 500 becomes accrued expense that will have to be recorded under our insurance expense. So now that will be accrued expense of 500 by the end of the current accounting period. And we are given the requirements after this information has been provided. Then under 1.1, it says we must prepare adjusting general interest number A, number D, number E, and number F, and number G. And they say dates and narrations may be omitted or are not important. Then 1.2 says we must prepare the ledger account for the stationery on hand, ledger account for the accrued income, and ledger account for the interest income. Then after, we are required again to do 1.3, where we have to consider all the relevant information and prepare the statement of profit and loss. Then also consider all the relevant information to prepare the statement of changes in equity. Then after, also consider all the relevant information and prepare the statement of financial position as at 31st of December 2012. So now I always give tips to students in terms of attacking this question. Whenever you are given this question where you are given a trial balance, and after the trial balance they give you the adjustments, of which these are the adjustments or the notes to take into account. And if again you are required to do the 3 statements, which is the income statement, the equity statement, and the statement of financial position, I always recommend that this must be the first question to do, second question to do, and the third question to do. Then all other questions will follow automatically. And after we have recorded the skeleton for the 3, then we can immediately do all the requirements or all the adjustments that appear from number A and up to number G. Therefore, now we'll do number 1.1, 1.2, and 1.1 and 1.2 later on. So I will start with the 1.3, 1.4, 1.5, then I'll do 1.2 because it is a very important approach to follow. So now let us start with the statement of comprehensive income, which is requirement 1.3 that we are doing. Then we'll do all other requirements immediately when we are done with these ones. 1.3, which is the statement of comprehensive income. So now in the statement of comprehensive income, we know that we are dealing with the incomes and the expenses. Statement of comprehensive income for the year ended. It is for the year that ends on the 31st of December 2012. So now it's for the year ended 31st December 2012. And we know that this statement starts with the incomes. Then we say income. That's where the statement starts. Then under income, we have service income because this business is a service income. And that service income was recorded as repairs. It's a repairing company. And there was another income which was interest income or interest received. So now there is interest income or interest received that we have to record under our incomes. And under our repairs in the trial balance, we were given the repairs income. Then under our repairs income, we have seen that the repairs income that we had was a total of 319,180. 319,180. 319,180. And there was also another interest income that amounted to 2,500. Interest income from the trial balance 2,500. Then we record that 2,500 as it is. Remember, we're just taking into account everything that we see in the trial balance. We take just everything that we see in the trial balance. Then after, we have to record the expenses, because these are the only two incomes that we have. Then after, we have to take into account expenses, where we have to say expenses. So now we record all the expenses as they appear in the trial balance. And under our expenses, we had stationery that was in the trial balance. And in the trial balance, we had stationery of 4,500. Let us check that stationery, the one that was an opening balance in the trial balance. In the trial balance, there was stationery opening balance, stationery on hand, and that stationery amounted to 800 rands. So now we record that as 800 stationery. Okay, sorry, stationery is not 4.5. It is 500. It is 800. So we record that 800 as stationery. Then after, we also look for another stationery that was purchased during the year. Stationery expense of 4,500. Yes, this is the one that I was talking about, the 4,500. Then we say plus 4,500. Always add the opening balance, that was an inventory of stationery, with the one that was bought during the year. You'll see that when I explain along the way. Then after, we also had another expense that is called rent. And rent expense was 156,000 rands. And there is our rent appearing as 156,000 rands in our trial balance. And here is our rent. There is our rent expense, 156,000 rands. We take that as it is, we record it in our income statement. There is our rent. The next expense is insurance expense. And our insurance in the trial balance is 8,600. There is the insurance 8,600. You just record everything that is in the trial balance that affect your income statement. Then after, we record telephone expense, which is 25,430. Telephone 25,430. Telephone expense 25,430 rands. Then after, we check for another expense, which is water and electricity, 18,900. 18,900 is water and electricity. Water plus electricity, 18,900, exactly as it is from the trial balance. Another expense that we have to account for, I think it was interest expense. We're supposed to have interest expense. If it was not here, we still have to take it into consideration. It was not recorded here. Okay, we only had accrued expense telephone. We'll do that later on. Then we have to account for the interest expense, because there was a loan. There was a loan from Basa Bank of 150,000 rands. So now let us account for the interest expense on the loan. Then we record the interest expense. And another thing that we have to account for is also depreciation. Let us not forget. Let us start with depreciation, then we record interest expense. We have our depreciation, and our depreciation was already given to us as 16,000 rands. And that depreciation was from our adjustments. We were given the first adjustment where they told us that depreciation for the year is 16,000 rands. There is our depreciation. So that has been already accounted for, is our depreciation expense for the full year, current year. Then from here we can just have our interest expense here at the bottom. Interest expense is normally the last one, interest expense, and it's normally called finance cost. I prefer to call it finance cost. So now there's no interest expense, we'll calculate that later on. And from here we'll get to the profit for the year. Profit for the year. Then after, we have to do the statement of changes in equity. Statement of change in equity with the opening balance, capital, drawings, and profit for the year. So we do the statement of changes in equity. Statement of changes in equity. And this statement is for the year end 31st December 2012. Statement of changes in equity for the year ended 31st December in the year 2012. For the year ended 31st December 2012. So now here we have the opening balance. This statement starts with the opening balance if there is an opening balance, which will be the capital, and our opening balance will be the capital of 102,000 rands. I think we did have a capital, and our capital opening balance was 102,900, and we record that as an opening balance 102,900. Then after, we record capital contributions, and there was no capital contribution during the current year. There was no capital contribution during the current year, that was not recorded. Then we record drawings, and we did have an amount of drawings in the trial balance. So now in the trial balance we had drawings of 20,450, and there was no adjustment regarding drawings, 20,450, but let us check, maybe there was an adjustment. Then we record profit for the year. Profit for the year, and our profit for the year will be taken from the income statement. It will be the one that comes from here. Profit for the year is the one that will be recorded straight here as a profit for the year. Then after, we do the next statement, which is, this was 1.4. Then we do 1.5, and 1.5 is the statement of financial position. Statement of financial position for the year ended, or not for the year, as at, sorry, statement of financial position as at statement of financial position as at 31st of December in the year 2012, as at 31st December in the year 2012. And here we start with the assets, and our assets are classified into current and non-current. And we start with the non-current assets. Then under non-current assets, we know that we have property, plant, and equipment. And under our property, plant, and equipment, we take into account property, plant, equipment, and vehicles. Don't forget that vehicles must be accounted for. So now we only have an item of machinery, and that machinery will be accounted for. So now we only record the amount of the machinery as it appears in our trial balance, as we have seen that the machinery is 105,000 rands. So we record that as 105,000 rands. Remember, we have to subtract the accumulated depreciation for that asset, and our accumulated depreciation given in the trial balance is 32,000 rands, and we still have to take into account depreciation for the current year, which is the 16,000 rands for the current year, because the accumulated depreciation that we see in the trial balance of 32,000 rands does not include the 16,000 rands that we see in the adjustments. So now hence we have to add the two so that we get to the sum of 42,000 rands, where we have to say 32,000 rands, which is this 32,000 rands that we see here, and we say plus 16,000 rands, which is depreciation for the current year. That will give us 32,000 rands plus 16,000 rands, and that will give us 48,000 rands, which is the total accumulated depreciation for equipment up to the end of the current year. Then we have to subtract 48,000 rands. Then we have already accounted everything regarding the equipment. Then there was a fixed deposit. And our fixed deposit was 152,000 rands, if my memory still serves me. There was a fixed deposit of 152,000. There is our fixed deposit, 152,000 rands. Remember, a fixed deposit is a long-term investment. It's a long-term asset. So now that 152,000 rands will be recorded under our non-current assets. Then now we record our current assets. And under our current assets, we know that there are only few things that we have, and it will be bank, inventory, and trade and other receivables. That will be bank. And our cash in the bank is also visible in the trial balance. Cash in the bank is 139,250. It is 139,250, 139,250. Then after we record inventory. In this case of inventory, we record inventory that is in the business by the end of the year. In this case, we will be told how much inventory was left. Normally, this will be the inventory of consumable items, which will be the inventory of stationery, but we'll do that later on when we do the journal entries. Then after we record trade and other receivables. Trade and other receivables. And under our trade and other receivables, we have to record the amount of trade and other receivables that we see in the trial balance, our debtors, which is 67,000 rands. That is 67,000 rands. So now we have to first record that as 67,000 rands. Then from here now we have to take into account all the entries that were visible in our trial balance. We'll do that as we continue. We had expenses that were accrued. We still have to account for that. And we also have expenses that were prepaid, and we also have to account for that. So now we have to take those into account. Remember, the accrual of 2,500 and the expense, that was the liability, and this was also accrued, so it will not affect our debtors. The accrued expense of 2,350 will affect our trade payables, and this will also affect our trade payables. So now there was no prepaid expense, and there was also no income that was accrued by the beginning of the period. So will not account for any opening balance of the accruals. Then after we go to our equity and our liabilities, we go to equity and liability. Then we say equity and liability. Equity plus liabilities. And under equities and liability, we start recording the amount of the equity. And the amount of the equity will be taken from the statement of changes in equity. The amount that will be taken here, the closing balance. Our closing balance here is the one that will be transferred straight to the statement of change in equity under this line item equity. So we'll account for that. And we go to non-current liabilities, or we go to liabilities and we classify them again to non-current and current liabilities. So now under our non-current, we will have a long-term loan if there was a long-term loan, and there was a loan from Basa Bank and it was payable over more than 12-month period. A loan from Basa Bank, a loan from Basa Bank, and a loan from Basa Bank. In the trial balance, it was given as an amount of a loan from Basa Bank, loan from Basa Bank. There was the loan from Basa Bank. The loan from Basa Bank was 150,000 rands, and we know that 50,000 of that is a current liability. So now let us say a loan from Basa Bank is 150,000 rands, because we still have to make an adjustment. Then after we go to current liabilities. We go to current liabilities, and our current liabilities are made of a short-term loan, which is also a loan from Basa Bank. There was a short-term loan from Basa Bank. Loan from Basa Bank. And the loan from Basa Bank, it was payable over a period of, on an annual basis of 50,000. And we were told that 50,000 will be paid in the following month. Then we have to subtract 50,000 there. Let me explain that part before I do anything. We were instructed that the loan is 50,000 and the loan is payable in annual installments of 50,000. This was the instruction, that the loan from Basa Bank is repayable in equal installments of 50,000 per year. So now it means every year we pay 50,000. That means 50,000 becomes a current liability. Why is it a current liability? It's because anything that is paid within 12-month period, it is recorded as a current liability. So now that is why out of the loan of 150,000 rands that we see in the trial balance, out of the loan of 150,000 rands, which is this loan, 50,000 will be recorded as a current liability. That is why we remove it from non-current liability and we transfer that to a current liability account. It is still a liability, but because it will be paid on the following day, then that will be recorded as a current liability, because they say the loan is payable on the first of January each and every year. So meaning that our long-term loan in total will be 100,000 rands. And our short term will be 50,000 rands, the one that is payable every month, every year. Then after we record our trade and other payables, trade plus other payables. So now under our trade and other payables, we have to record the amount of the trade payables that we see in the trial balance. In the trial balance, we have creditors, which is trade payables of 102,000 rands. So now we start with the 102,000 rands and we record that as is. And we say 102,000 rands is our trade and other payables. And we have to check if was there any expense that was accrued in the trial balance. Any expense that was accrued perhaps in the trial balance by the beginning of the year. And in the trial balance, we did have an accrued telephone expense. And the accrued telephone expense was recorded in our trial balance as 2,350. That was our accrued telephone. So now that will have to be taken into account. There was accrued expense of telephone 2,350. And there was another accrued income. Okay, this was accrued income. There is the accrued income. We'll also account for that 2,500. So now we'll account for all the accruals immediately when we do the adjustments, where we first have to make reversals for all of them. So now let us continue on that same note. Then we continue now with the next entry, and we check now in our adjustments. We have done everything that was supposed to be recorded. Then we'll go straight to our adjustments. And when we go to our adjustments now, we have to account for every journal entry that we see in our adjustments. So now we check our adjustments and we do every journal entry. And remember, this journal entry was already recorded. However, I'll just repeat it for the sake of full understanding, so that we record it in all areas where it is supposed to be recorded. So now we have done the income statement first. That is very important. We have done the income statement as it was supposed to be. Then after we have done the income statement, we have done also the statement of changes in equity. And after we have done that, we also had to account for or do the statement of financial position. So from here now, guys, I will do all the journal entries as they appear in our adjustments, and I will do them in the form of general journal, and every entry will be recorded where it is supposed to be recorded. So we have our adjustments that are given below the trial balance. And our adjustments, first of all, is number A, where we have to do the depreciation of 16,000 rands. And our depreciation is already given to us as 16,000 rands. So now we will debit our depreciation, and depreciation is 16,000 rands, and we credit accumulated depreciation. So now when we credit accumulated depreciation, it means we're reducing our asset by 16,000 rands. So now we have recorded this in the statement of financial position, where we said 48,000 rands, and 48,000 rands was made of 32,000 rands plus 16,000 rands. Remember, this sum of the two became 48,000 rands, and 32,000 rands was the accumulated depreciation that was in the trial balance. That accumulated depreciation in the trial balance that appeared there to be 32,000 rands, it was already given. So now we just recorded that as 32, and we added the 16,000 rands that appear in the adjustments. So now, meaning that the side of the entry, which is the credit side, is being accounted for. However, we still have to record this because depreciation is an expense. This is an expense account. So now we have to record it under our income statement once again. So now under depreciation, under the income statement, we must record that depreciation is 16,000, and we have already done that. So now if we have done that already, we can just record our depreciation as the total of 16,000 rands under our income statement. Then now we have to do the second journal entry, and the second journal entry is number B. And number B says that the fixed deposit bears interest at 5% per annum, and the interest on the current year has not yet been accounted for. So now it means the full interest was not yet accounted for. So now we have to account for that interest on the fixed deposit. So now we go and we check the amount of the fixed deposit that bears interest at 5%. So now if that is the case, it means our fixed deposit of 152,000 rands will be 152,000 rands. We multiply that by 5, we divide it by 12. It will give us 152,000 rands. We multiply that by 5 and we divide by 100. Then that gives us 7,600 rands of the interest on the fixed deposit. So now we have to record that in the general entry. And remember, this interest was not accounted for. So now if it was not accounted for, it means all of that was accrued. So now under number B, we record accrued income. Then we will have to credit interest income. Interest income. Why do we record this as accrued? It is because it was not yet received. So now we have 7,600, 7,600. It was completely not yet accounted for. And remember, accrued income is an asset. So now we know that is an asset. It is an asset, and if this is an asset, it will have to affect our income statement. That is our asset, and we know that this is income. So now meaning our incomes must be increased by 7,600 because income increased on the credit side, and this is the credit side. Then our assets must also be increased by 7.6 because this is an asset and it will be recorded in our current assets. So now under our current assets, under our trade and other receivables, we have to say plus 7,600. Plus 7,600. Then now we have to record another 7.6 under the income statement. And we record that under our incomes, we say plus 7,600 rands. So now we have accounted for that. Then we go to the second or to the third entry. And the third entry is the one that we see again in the trial, in the adjustments. In the adjustments is number C, and number C tells us that stationery on hand at year end was an amount of 750. So now that is stationery as an asset. Stationery on hand, and we record that as stationery on hand, debit stationery on hand. And stationery on hand is an asset, which is the inventory left at the end of the year. So now we credit our stationery expense. We credit our stationery expense, and our stationery expense is 750. So now this will go to the balance sheet because it is an asset. This will reduce our expenses because whenever we have inventory left, that is reducing our expense. Then inventory of stationery will be 750. Inventory of stationery will be 750, and our stationery expense will have to be reduced by the amount of 750 in the statement of comprehensive income. Then under our stationery expense, we say less 750. Less 750. Less 750. So now that will give us the stationery on, or stationery used. The net will be the stationery used. Then after we go to the next journal entry, this has been recorded and this has been recorded. This is recorded under income statement and this is recorded under the balance sheet. Then we go to the next journal entry. The next journal entry tells us that the accountant has recorded telephone expense accrued 2,350 on the 31st of December 2012 by making the following entries. Debit telephone 2,350 and credit accrued telephone by 2,350. And it says, however, it was noted that the accrued telephone expense at year end is actually 2,530. So now it means the telephone account was underestimated, and again the accrued expense was also underestimated because instead of recording 2,530 they recorded 2,350. So now everything was underestimated. So meaning now we have to say 2,530 minus 2,350, that will give us 180. and for that 180 we have to debit our telephone expense. We have to debit our telephone expense and debit our telephone as 180, and we credit our accrued telephone. So now our accrued telephone expense will be 180, meaning our telephone expense must be increased by 180 and our accrued expense must also be increased by 180. So now we go to our accrued expenses in the statement of financial position, because this is a current liability. This is a current liability. So now under our current liabilities, we first have to record the 2,350 plus 180, because the accrued telephone expense in total was supposed to be 2,530. So we record 2,350 plus 180, so that at the end of the year our total accrued telephone expense is a sum of 2,530. So now that's why we record both amounts, and that is the sum of 2,350 plus 180. Then after we record the second entry in the income statement, the 180 under our expenses, the 180 which is the one on the debit side, we record that on the debit side of the telephone, and our telephone will be plus 180 because it was underestimated by 180 rands. Then we continue again in the same note. We check for the next general entry. We check for the next general, oh sorry, that is not the telephone. Our telephone is plus 180, sorry for that. And then we go to the next general entry, and the next general entry is entry number E. Only two entries are left. Entry number E says that the loan is repayable over a period is paid every year by 50,000 rands per annum. So that is the annual payment, and we have recorded this, where we recorded that as a current liability. Why? Because it is payable within 1 year. We recorded that 50,000 rands there as the current liability, and we took that from the long term, we transfer that to a short term loan. So now we have recorded that already as it appears here. And why did we do that? Is because the next 50,000 will be paid on the 1st of January 2013, and we are doing the books. Remember, the books is for the 31st of December 2012, and 1 day after 31st of December 2012 becomes the 1st of January 2013. That means 1 day after, a payment of 50,000 will be made, and anything that is paid in a period or payable in a period less than a year, that becomes a current liability. That is why the 50,000 appears under our current liabilities. Then after we have number F, where it says rent is paid in advance 1 month, and the rent expense therefore include the rent for January 2013. So now it means there was a prepaid rent that appears in our, or that is already paid by the end of December in the year 2012. So now if that's the case, it means we have to record a prepaid expense. And in recording a prepaid expense, we have to go to our trial balance first and say how much is the prepaid expense first. And this is the prepaid expense by the end of the current year. We still have to do the reversals. I have not yet forgotten the reversals of the opening balances of the accruals. I will do that immediately when I'm done with all the general entries. So now our rent expense appears in our trial balance as an amount of 156,000 rands. This is our rent expense. So now we said that 156,000 rands must be divided by 12. After we divide this by 12, it will give us rent per month. 156,000 divided by 13. That will give us 12,000, because this 156,000 rands is the rent for 13 months. So now we need to know how much is the rent per month, which is 12,000 rands. So now if it's 12,000 rands, it means 12,000 rands is the one that will be recorded as prepaid expense. Why do we say it is prepaid expense? Because the adjustment has instructed us that rent is paid 1 month in advance. 1 month in advance. That means it is prepaid. That means the rent that we paid by December include a rent for January 2013. They made mention of that very, very clear. Meaning now our prepaid expense is an amount of 12,000 rands. So that is number F, because number E was just a loan. Number F. Then we debit prepaid rent. Remember, prepaid expense is an asset. Then we credit our rent expense. And the amount is 12,000 rands. So now it means our 12,000 must be recorded under our current assets as under our trade and other receivables, because the amount was paid and still for us. It is receivable. So now 12,000 will be recorded under trade and other receivables plus 12,000 rands. So now we have recorded that as our prepaid rent of 12,000, and we have to record that in the income statement, where we go to under rent and say minus 12,000 rands. Why must 12,000 rands be subtracted? Is because the rent of 12,000 is not for the year 2012, but the rent of 12,000 that is included in that 156,000 rands is for the first month, which is the month of January 2013. So now it must not appear in the income statement for the year 2012, because it is for the next financial accounting period. So now we have accounted for rent both in the income statement and also in the statement of financial position. And that was entry number F. And the last but not least, the last entry says that after careful review, it was found that the insurance expense for December, this is an expense for December, and the amount of 500 was not yet accounted for, meaning 500 of the insurance expense was accrued. So now the minute it was accrued, we have to account for that as our expense to be payable, and you also have to record that in the income statement again. So 500 is accrued expense. So if it is accrued, it is a liability, and any accrued expense is a liability, and liabilities increase on the credit side. Then we do number G, and we debit insurance. And this is insurance expense of an amount of 500, which was not accounted for. Then we credit accrued insurance, and the accrued insurance expense is a liability. Accrued means not yet, meaning in this case an expense not yet paid. So now we have to record this in the income statement, and this under trade and other payables. 500 under the income statement, where our expenses in terms of insurance have to increase by 500. Then we go to the statement of financial position. Under trade and other payables, we record the 500 because this amount was not yet accounted for. It means it was not yet paid, so it was accrued by the end of the current year. So now we have tackled all the adjustments that were necessary and relevant to our financial statements. So now from here, one thing that I should have done it in the beginning is to do the reversal entries. I should have done that in the beginning, is to check for any entries that needed to be reversed. For any entries that needed to be reversed. So now we have to check for all those entries that were visible in the trial balance as opening balances, all the accrued and the expense that were prepaid and were the opening balances. These are always very critical to account for. There was accrued income 1st January. There was accrued telephone, and the accrued telephone was 2,350. And these entries, guys, are always very, very critical. Remember, when it comes to telephone, there's something that is important with the telephone. Regarding the telephone, they don't write the date. Here, there's a date, 1st of January. But regarding the telephone, there's no date. Question mark. Why there's no date? The reason why there's no date is because in one of the journal entries, it was clearly stated that the accrued telephone, number D said the accountant has not yet recorded telephone expense accrued when by the end of the current year. So now this accrued telephone of 2,350 is the one that was accrued by the end of the current year. So now it means the accrued telephone that we see here is at the end of the current year, 31st December, not beginning of the year. So now that is why there is no need for a reversal when it comes to this. Very important. Because sometimes when we see an accrued expense, we always think of the reversal if we see that in the trial balance. But when it comes to this, it is with exception because it was accrued by the end of the current year. But this one was accrued from last year and it became an opening balance. So now because of that reason, then this needs to be reversed. Please take that into account, guys. So now we only have to do a reversal of this and do a reversal of this, which is the 800 reversal and the 2.5 reversal. These are the only one that need the reversal. We don't need a reversal here. Reversal here is not applicable, please, because it was accrued by the end of the current year. And once again, remember that this was accrued by the end of the year and it is not recorded under our creditors. This amount 2,350 is a liability. We know any accrued expense by the current year is a liability, but this amount is not included under our creditors. That means under our trade and other payables, or trade and other payables is not included. That is why they separated this entry. So it means it is not yet included here. That is why when I did the statement of financial position 2,350, I recorded that as 2,350 in the trade and other payables. There it is separate. So this is the accrued expense that was underestimated, and this was the difference of 180 that we added, so that the total accrued expense becomes 2,530, which was the correct amount. Remember, the accountant did an error. So now that is the reason why we had to add the 180 under that 2,350. So now, very important what I'm highlighting, guys, regarding this question paper, because they tricked it a little bit. So now we have to do reversal for this and do reversal for this. Then after, we have to account it for. So now before we do a reversal, we first have to record this, because this is the stationery that will have to be transferred to the stationery expense, and I think we did an entry for that, or we did not do any entry for that. Let us do an entry for that stationery. So now we are doing the reversal entries. So now with regard to the stationery, a reversal will be done where you have to say debit stationery expense, by 800, and we create the stationery on hand. And this is for an amount of 800. Why are we doing this? Is because the stationery, which was 800 opening balance, would have been used during the year. And the stationery of 800 will be transferred to an expense account. Why that is the case is because I told you that we are using a method where when we record stationery expense, or whenever we record consumable item, or whenever we buy stationery, or whenever we buy cleaning material, or whenever we buy consumable items, they must be recorded under stationery expense account. Then whatever is left at the end of the year, it will be an asset or inventory of stationery on hand. So now we are transferring this in the current year to an expense account. Then at the end of the year, whatever is left becomes an asset. So now we are transferring this to its normal account, which is an expense account. Then after, we have to do an entry for the accrued income of 2,500. Remember, this was accrued, it was an asset last time. Then we have to transfer now to an expense account for the current year. So now it was no longer accrued, then we have to reverse that 2.5. So now it was accrued income, take into account it was accrued income in asset, then we removed it from the asset account. Now it's no longer an asset. So we record that on the debit side, where we record interest income. On the debit side, we record interest income, and we credit accrued income. And the accrued income is 2,500, and this is 2,500. So now we have made a reversal for this entry. So now immediately the minute we have done the reversal, we have to also record this reversal. Remember, this has been recorded, and this is recorded because here we are cancelling the credit side, which is stationery on hand. We are cancelling the asset, and here we are recording it under the expense. So that's why we recorded the 800 under the stationery expense in the income statement. If you look in the income statement, we have stationery expense of 800. That is the 800. So now we are cancelling the 800 from being an asset, and we transfer it to an expense account, because whenever we acquire or whenever we buy stationery, we record it as an expense or under the expense account. So we are recording this under the expense account, and we are removing it from an asset account, because stationery on hand is an asset. We are removing it from an asset account, and we are recording that as an expense account. So now that is why we only record the 800 under the expenses, which is under the income statement, because the other one, which is the 800, is just a cancelling of an asset account. Then after, we have to again take into account the interest of 2.5, and that interest of 2.5, which is the interest income, supposed to appear in our income statement, and that has been already, it has to be accounted for in our income statement. The 2.5, it has to be accounted, because our interest income is decreasing by 2,500 rands. So now, once again, this was an asset. Remember, this was an asset. So it was an asset. That is why it appears in the trial balance on the debit side. This was an asset by the 1st of January. But by the end of January, this was no longer an asset. So now the reason why I'm emphasizing that is because the credit side of this entry, we are cancelling the asset. And the debit side of the entry, we are recognizing, or we are reducing our income, where the contra entry becomes interest income of 2.5. So now the only one that we are recording now is only 2,500 rands, and that will be negative under our interest income in the income statement. So now we record that as 2.5 in the income statement. So under our incomes, we say less 2,500. Then we draw a line there then it will be completely done. So now we have accounted for everything. We have accounted for everything that needed to be accounted for. Now let me just highlight one other thing that this could be done. If you want, 2.5 can be recorded under assets as a plus and a minus, of which at the end it makes no difference, because by the beginning of the year this amount of 2.5 was a debtor. This amount, it was accrued in January, and by the beginning of January this was a debtor. So if you want, you can first add this in our debtors and you say 2,500, and when you make a reversal you say minus 2,500. At the end it makes no difference, you get the same thing. So now I'll decide not to add any of that in our debtors. So now with that being said, we can calculate all the incomes and expenses that appear in our income statement. 319,180 the total, and here we have 2.5 minus 2.5 plus 7.5, that will give us 7,600. 7,600. Then after we have our expenses, and our expenses in terms of telephone, we have an amount of 800 as 800 plus 4.5 plus 4.5 minus 750, and that gives us 4,550. That gives us 4,550. That will be the stationery used. Our rent expense will be a sum of 156,000 rands, less 12,000 of the rent that was prepaid, then that will give us 144,000 rands. And 144,000 rands will be our rent expense. Then insurance will be 86,500, 86,500 in brackets, and telephone will be 2,530, and water and electricity, there was no adjustment, it remains 18,900. Make sure that your expenses are negative. Depreciation is still the same, 16,000 rands. Then withdraw a line. Remember, finance cost or telephone or interest expense must be outside the total expenses. So now our interest expense on a loan, there was interest expense, and our interest expense on a loan, we also had accrued expense. We also had accrued expense, which was, we have already accounted. No, it was a telephone, sorry. There was no interest expense that was accrued. There was no interest expense. Okay, so now we have to check our loan. Our loan is 150,000 rands, and our adjustment told us that interest expense amounted to, or our interest expense is calculated at what rate. We have to know our interest expense. It says under number E that the loan from Bursar Bank is payable. Then they give us that. They don't tell us how much is the interest on this loan. They don't tell us how much is the interest on the loan. We are not given the interest on the loan. So now let us check how this interest was calculated. Let us check how this interest was calculated. Interest expense, interest expense, interest expense, interest expense. Okay, there is the interest expense. Sorry, interest expense is 10,005. I don't know how I forgot to record it. Interest expense is 10,500, and there was no adjustment. Interest expense is 10,500. Sorry that I forgot to record that, and there was no adjustment. So now let us add all the expenses, and when we add all the expenses, we start from here and we go down only this box, and our total expenses will give us an amount of 218,160. It is 218,160. That is the total of the expenses. And our total incomes, which is the sum of the two incomes, will be 319,180 plus 7,600, and this will give us 326,780. It will be 326,780. So now this is our total. Let me just confirm these expenses. Our expenses 4,550 plus 144,000 plus 86,500 plus 2,530 plus 18,900 plus 16,000. This is 272,480. Okay, let us see again, just recalculate this. Okay, our insurance is how much? Oh, sorry, sorry. Our insurance is incorrect. Is a sum of, our insurance is 8,600 plus 500 plus 500 is 9,100. Sorry for that. I just perceived it incorrectly. So now we have 4,550 plus 144,000 plus 9,100 plus our telephone expense. Yeah, telephone is also wrong. Our telephone expense will be a sum of 25,430 plus 180, 25,610. Okay, sorry for that. 25,610. Just a matter of being tired. 4,550 plus 144,000 plus 9,100 plus 25,610 plus 18,900 plus 16,000. That is 218,160, or that is 100% correct. Now all the amounts have been confirmed. Then we calculate our profit for the year, and our profit will be less our incomes, or incomes less expenses. So now when we do that, we just say less 326,780, then plus 10,800, which is the interest expense. Then this will give us 97,820, 97,000. Let us confirm it again. 32,000 or 326,180, 780 minus 218,160. That gives us that amount minus finance cost, which is 10,500. That will be 98,120. So now we get to 98,120 rands. 98,120. That becomes our profit for the period, and profit for the period will be 98,120 here. And our drawings, there was no adjustment for drawings. We still have 20,450. Then after we get to the closing balance. our closing balance will be 98,120. Remember, the drawings will be negative. Then we say plus opening balance 102,900. 102,900. Okay, 102,900 plus 98,120, which is the profit, minus 20,450. That gives us the amount of the statement of change in equity is 180,570. 180,570. 180,570. So that is our balance at the end of the period. Then after we do the statement, so now this amount will go straight to our statement of financial position, 180,570. 180,570 will go straight here. 180,570. 180,570. 180,570, which come from the statement of changes in equity. Then immediately we record everything that concern our asset and our liabilities. In fact, we just calculate the totals because everything has been accounted for. Then now we have to say, remove these calculations. We say 105,000 minus 48,000 rands. 105,000 minus 48,000. Minus 48,000. This will give us 57,000 rands as the amount of the carrying value of our equipment, which is an amount of 57,000 rands. So we record that as 57,000 rands as it appears in our calculations. Then after we had a fixed deposit, and fixed deposit is 152,000 rands. Then our bank, there was nothing that affected our bank regarding the adjustment, 139,250. And our trade and other receivables, we recorded few things. We recorded 67,000, we recorded 12,000, and we recorded 7,600. Then we have to add all these three and we see how much do we get. So now we say 67,000 rands plus 7,600 plus 12,000, and this will give us 86,600. 86,600. We record that as 86,600. Then after we account for our loan, we've done the long-term loan. Okay, let us first do the total of the assets, all of them, so that we prove that everything is balancing. So now we calculate that total, where we say 57,000 plus 152,000 rands. That gives us 209,000, which is our non-current. 209,000 rands. Then after we say 139,250 plus 750 plus 86,600, then that will give us 226,600. 226,600. So now that is our total current assets. And we go to liabilities. Our non-current, it will be the loan from ABA Bank, and the loan from ABA Bank amounted to 100,000. That is 100,000, and we draw a box for that. It becomes 100,000. And our current liabilities, we still have to adjust for or make additions, where we have to say 102,000 rands plus 2,350 plus 180 plus 500, and that gives us 110,030. So that will be 105,030. Then that will be the total of our current liabilities. Plus 50,000 rands, then it will be 155,030. Then you say 155,030 plus 100,000, that gives us 165,030 plus 100,000 plus 100, that gives us 265,030. Then we add the equity, which is 180,570. Then this will give us the total of 430. Let me check it again. 180,570 plus 100,000 plus 155,030, that gave us 435, which is total equity and liability. This is 435,600. This is our total equity and liability. Then we go to our assets. We check if does everything balance. 209,000 plus 226,600. That also gives us 435,600. And the minute the two are balancing, we have already got many marks in this question. I always start with this question because more marks are here, guys. If this balances, then everything is fine. So now from here, we can go and do according to what was required in terms of 1.1 and 1.2. 1.1 we're required to do general entries A, D, F, and G. A, D, F, and G. We have done that already. A, D, F, and G. General interest for A, D, F, and G. So this will be 1.1. A, D, 1.1. F, and G. So we still have to do number F. We still have to do number F. What was in number F? We're required to do A, D, F, and G, and number F we are required to, number F was to, okay, they said the rent is paid 1 month in advance, and the rent expense, therefore, it include the rent of 13,000. I think we have done number F. Prepay the rent of 12,000. Yes, this was number F. 1.1. Then we have to do the next one now. We have done all the 1.1s questions, A, D, F, and G. Then we have to do 1.2. 1.2 is the 3 ledger accounts. Then after we are done with this question, 1.2, the ledger account for the stationery on hand, and which is a very straightforward ledger account. Our stationery on hand, we know that we had an opening balance. So now we are doing 1.2, stationery on hand. And our stationery on hand had an opening balance, and an opening balance is a debit balance for the stationery. And that opening balance was an amount of 800. And the 800 was in the trial balance, remember. Stationery on hand, there was an opening balance of 800, there is the opening balance. Then after, we transferred that into an expense account. Remember, we transferred that through the general entry, where we did the reversal, transferring that. So this was the entry of the transfer, where the stationery on hand is transferred to an expense account on the debit side. So stationery on hand was credited by 800. Contra entry will be stationery expense. So now that's what we are doing. So we credit our stationery on hand by stationery expense, where we transfer that into an expense account, which is 800. Then after, there was a stationery bought during the year. No stationery left at the end of the year. And the stationery that was left at the end of the year amounted to 750. Stationery on hand by the end of the current year. So now we have to record that on the debit side. And contra entry will just be stationery, which is stationery expense. Stationery expense of 750. And from here now we can balance this ledger account. Then the bigger side will be 1,550. 1,550, and we have a balance here. Balance carried down will be 750, and balance brought down will be 750. So that is the first ledger account that was required, and we have done this ledger account. And the second ledger account that was required was the ledger account of the accrued income. Remember, accrued income had an opening balance in the trial balance, and this accrued income, it is accrued income, which is interest income. Let us check if was there any accrued opening balance in terms of the interest income. Yes, there was accrued income, interest income. So now we must start again with the opening balance for that accrued income. So we record accrued income, interest income. Accrued income, which is interest income. And accrued income, remember, is an asset. So the opening balance for that will be on the debit side. And even beside that, it is appearing on the debit side. So that will tell you that definitely this is an asset. So opening balance of 2,500 will be on this side, and it will be a balance. Then there has to be a reversal of 2.5 on this side. Why? Because by the end of the current year, this was no longer accrued. Then the contra entry will be interest income. So now this will be a reversal. This will be a reversal. Then after we record, I think there was accrued income of 7.6 by the end of the current year. We did record that. Let me check. There was accrued income by the end of the current year, which was 7,600 years. Number B. Number B, there was accrued income where we debited accrued income of 7,600 because this was all accrued, not yet accounted for. And I said this is an asset. So now we debit our accrued income by 7.6. Contra entry will be interest income. So now we debit our accrued income by 7,600. Contra entry will be interest income. Then from here now we can balance this ledger account. You can balance this ledger account. And in balancing this ledger account, we take the amount of the bigger side, and the amount of the bigger side is the debit side, which is 10,100. 10,100. Then we say 10,100. We subtract 2,500. And that will give us 7,600 again on the credit side. 7,600, and the 7.6 will be the balance. And this will be the balance carried down, 7,600, balance brought down. Balance brought down. So now this ledger account is also completely done, and the last ledger account as the requirement is the interest received ledger account. The interest received ledger account, it is an expense account. So it is an income account. So interest received is an income account, and we record that and we have to start with the interest that was received in the trial balance. In the trial balance, we have interest that was received, and the interest that was received in the trial balance amounted to interest received of 2,500, which is just the total in the trial balance. We start with that whenever we do the ledger account for an income. Interest received and the interest that was received, we start with the total from the trial balance, and we say total from the trial balance is 2,500. Then after, we have to account for the reversal of 2.5. There was a reversal of 2.5 from the trial balance. Once again, from the trial balance, there was a reversal of the interest income, the one that was accrued. There was a reversal here that was done, and in this reversal that we did, we debited our interest income 2.5. I'll show you the reversal. In the reversal, we debited our interest income by 2.5. There was the reversal. This was the reversal entry, 2.5. So now this was 2.5 where the interest income is debited, and with that we will debit 2,500, and the contra entry will be accrued income. Contra entry will be accrued income. Then from here, now we have to record the interest that was accrued again by the end of the current year. There was 7.6 that was accrued by the end of the current year, 7.6. There under number B, interest income was credited, 7,600 was the amount. So now we record that on the credit side, and we record that 7.6 as 7.6 for the accrued that was accrued by the end of the year, accrued interest. Therefore, now we can close off this ledger account. We can close off this ledger account, and the bigger side will be 10,100, 10,100, and the contra entry will be profit and loss, 7,600. And this amount is the one that's supposed to appear in the income statement, profit and loss, and it is exactly the same amount as 7,600 as it appears in our income statement. That is the income statement amount. With that being said, I think I've covered all these requirements, and I've covered all of them, 1.1 and 1.2, 1.3, 1.4, and these are the major ones. With that being said, guys, thank you. Hope you'll learn something from this video.